In this video, you will learn how you can value any stock, any business, by following just 3 simple steps. In fact, the valuation technique that I will share with you today is certainly much simpler than a complex, sometimes overwhelming DCF valuation model, so a discounted cash flow approach. All you need for today's valuation method is basically a pen, a paper, and some basic math. And of course, a good understanding of the company itself. And I can guarantee you that you will be a smarter investor after watching this video. So without further ado, let's get started. Hello fellow intelligent investors, my name is René Salman, and as you might know, there are all sorts of valuation techniques that investors can rely on. There are, for example, relative valuation approaches that can further be subdivided into relative valuation approaches that compare a company's price to that of peers, so companies that operate in the same industry. But you can also value a company on a relative basis by comparing its current valuation multiple to valuation multiples the very same company was trading at in the past. Absolute valuation work, on the other hand, evaluates the true value of a company without comparing it to the valuation of peers. An investor favorite here is certainly the so-called discounted cash flow model, or in short, DCF. And Warren Buffett himself, he supposedly uses a DCF to calculate the intrinsic value of companies he invests in. You've got probabilistic valuation techniques, and then of course you've got literally hundreds of different valuation multiples that you could use to value businesses. So for instance, price to sales, price to gross profit, price to operating income, price to free cash flow, enterprise value to free cash flow, enterprise value to book value, and so on and so forth. I think you get the idea here. And all of these valuation methods have their advantages and disadvantages. But one major point of criticism of more complex valuation techniques, like the DCF model for instance, is that they are so complex that your intrinsic value estimate will most certainly be wrong. And I would actually argue that you can show me any DCF that was created 10 years ago, and I will show you today how wrong the estimates actually were and how wrong the intrinsic value estimate was. It's basically only a matter of how far off the DCF will be. So if you place too much emphasis on this DCF intrinsic value estimate, this can of course lead to very costly investing mistakes. So one alternative to keep things more simple is to focus on 2 or 3 key drivers of that investment, and of course to also shorten the time horizon for which you come up with your best educated guesses. So let me present to you this more simple valuation approach, and for the sake of this video I will actually consider the website builder and app building platform Wix.com and use this stock as an example. And by the way, if you want to get a better understanding of what Wix, the business, is actually doing, how it makes money and what kind of moat surround the business and protect the business, of course, I certainly recommend taking a look at the video that I published on my channel last week. Okay, so let's focus on the first step of this more simple valuation approach. The first variable that you want to consider is the expected revenue growth rate over the next 5 years. And how do you do that? Well, if you watch some of my previous videos, you will know that I'm a big believer that developing a qualitative understanding of a business is highly important. Sure, you could just head to a random financial website and take a look at the analysts' growth estimates, but personally I think that quite a lot of analysts' forecasts are actually fundamentally flawed due to the incentive structures of that industry. And I also think that you will have a very hard time building your own conviction in your stock idea if you don't understand how likely those growth rates actually are. You need to assess if they are maybe a little too optimistic, too conservative, and so on and so forth. So what's your alternative? Well, as I said, you yourself have to understand the business, its business model, which phase of the business life cycle the company currently goes through, the reinvestment opportunities, its competitive advantages, its historical growth rates, and so on and so forth. Moreover, you need to develop a good qualitative understanding of the industry the business is operating in. So the tail or headwinds of that industry, expected growth rates of the industry, and of course the major competitors competing in that space. So if we consider Wix.com, for example, we will first of all have to head to the company's most recent financial statement, which in the case of Wix is its fiscal year 2021 annual report. And there we can find the firm's last 12-month revenue on the income statement, which in the case of Wix is around $1.2 billion. Next, we should take a look at the historical revenue growth rates of Wix. And here we can see that the Israeli-based website builder has consistently been growing its revenue, its top line, at 26 to 46%. Now, interestingly, in the most recent quarter, growth has actually slowed down quite significantly to 16% year over year, and management also guided for only 11 to 13% year over year growth for the next quarter. So what I will do here is, based on my understanding of the business and its growth opportunities, the tailwinds of that industry it is operating in, I will assume top line, so revenue growth of 15% over the next 5 years. And quite frankly, I think this is actually a rather conservative growth assumption, especially considering Wix historical growth rates and also the fact that they have more than 220 registered users, of which only around 6% are, not 6%, sorry, 6 million are paying subscribers. So if we just combine the 216 users of Wix that are not a paying user yet, if you combine that with the level of innovation that the company has shown in the most recent years, I think there's actually a long runway for growth left. So anyway, if we now take the current revenue of $1.269 billion and want to figure out how much revenue Wix will generate if they grow their top line 15% annually for the next 5 years, well, then we have to use the following formula. Revenue in 5 years equals last 12-month revenue multiplied by 1 plus revenue growth rate to the power of 5. And if our assumptions hold true, then Wix will generate revenue of $2.5 billion in its 2026 fiscal year. Maybe just as a side note, this estimate is actually below analysts' estimates. All right, the second step to consider is what I call margin at maturity. So more specifically, you want to think about what kind of free cash flow margin you expect the company to post in 5 years' time. So in a way, you are trying to estimate future profit margins. And again, if you've developed a good understanding of the business and specifically its fixed and variable costs, you should have a decent idea of what future free cash flow margins could look like. And just to be clear here, when I'm speaking of free cash flow margin, we essentially need to distinguish between maintenance investments and growth investments, because free cash flow is basically the cash a company generates if you subtract maintenance capital expenditures from operating cash flow. So let's consider Wix again. I think their core business, so the creative subscriptions business, should generate gross margins of around 80%. According to management, a little less, but for the sake of simplicity and for the sake of this video, let's just assume 80%. So this means that the cost of goods sold for Wix business is actually 20% of revenue. So those are the main variable costs of Wix business. So costs that actually increase or decrease with the company's sales volume. And actually Wix variable costs may be a little higher now as other revenue streams like payment, for example, which has a less attractive margin structure, have actually grown and now represent a larger portion of total revenue. And as a result, the gross margin of Wix has actually deteriorated or declined over the last couple of years. So again, the main variable costs can usually be found above the gross profit line on the income statement. And conversely, the main fixed costs can actually be found below the gross profit line on the income statement. And for Wix, that's mainly sales and marketing expenses and of course, research and development costs. Over the last 12 months, Wix has actually spent $512 million on sales and marketing, so around 40% of revenue, and $424 million on research and development, representing 33% of revenue. So taken together, research and development and marketing costs make up more than 70% of Wix revenue. Now, I think you could certainly imagine that once Wix is no longer growing as quickly as it has in the past and is right now, and stops reinvesting all of its profits back into the business, that those expenses, so research and development and marketing, will be much lower. If you now assume that these expenses can go down to, say, 45% of revenue, then you already end up with a profit margin of 25%. But just to be a little more conservative here, let's go for 20%, so a 20% free cash flow margin at maturity. And just to add a little nuance to this, to come up with a reasonable margin estimate. Understand the business and its cost structure is certainly critical, but there are actually two other things you might want to do on top of that. Firstly, looking at the margin structure of competing companies that operate in the same industry might be a great reference point. And secondly, maybe management itself gave you some hints during earnings calls or investor presentations, and this is what Wix management has actually done in 2018, or maybe it was 2019. They actually pointed out that they expect free cash flow margin to be above 30% once the business has become more mature. And during the most recent earnings call, management hinted at the fact that they expect free cash flow to be above 20%, even though payment transactions make up a larger percentage of total revenue. So just to end this second step, assuming a 20% free cash flow margin, we expect Wix to generate $510 million in free cash flow in 2022. So basically, you just multiply the revenue in 5 years by 0.2. All right, before we move on to the third step, if you get some kind of value out of today's video and want to be informed about future videos, I highly recommend subscribing to the channel. And of course, liking the video and leaving a comment helps a long way as well. Okay, moving on to the third and final step of this valuation method. Well, we now have to find an appropriate exit multiple. So what kind of free cash flow multiple do you think is reasonable to assume the business might be trading at in 5 years' time? And maybe as a general rule of thumb here, the higher the quality of a business and the faster the growth, the higher the multiple the business is trading at, on average. And conversely, the slower the growth, and growth might actually be negative, and the worse the quality of the business, the lower the multiple. Now, Wix.com, for example, is growing rather quickly. And even if we assume slowed growth of 15% annually, that's still above average revenue growth. And so the business should deserve to trade at a higher than average multiple. Now, on top of that, the market generally likes certainty and predictability, which is why companies with so-called recurring revenues that are not very cyclical in nature tend to trade at higher multiples. And Wix subscription model certainly or naturally leads to highly recurring revenues. So I think it is actually very reasonable to assume that Wix will eventually trade at 25 times free cash flow. Okay, and now that we have an exit multiple, we can actually take a look at the final equation. So I'll just show it to you on the screen right now. And if we now plug in the numbers that we have determined for our Wix analysis, then we get to $12,762,000,000. So what is that? That's the market cap Wix will be trading at in 5 years, according to our assumptions. If you would divide that number now by the total number of shares outstanding, you would actually get the price on a per share basis. And once you have the market cap in 5 years, what you want to do is you want to compare that future market cap to the stock's current market capitalization. And then you can figure out what kind of compounded growth is needed to arrive at that future market cap. To do that, you can either use a compound growth calculator that you can find online, or you can of course also create your own spreadsheet that does the calculation for you. All right, to keep things simple and so that you can copy what I'm doing here at home, let's go for an online solution. If we use the NerdWallet compound interest calculator, for instance, then what you could do is plug in Wix current market capitalization in the initial deposit field. So as of the time I am recording this video, that's $4.9 billion, or we can just type in 4,900 million US dollars. We then go for an annual compound frequency, and then you can basically play around with the estimated rate of return box. And what you'll try to do is you try to find a compound growth rate that is needed to arrive at a market cap of 12.7 billion US dollars, or again 12,700 million US dollars in 5 years. And yeah, 21% is actually pretty accurate. So if all of our assumptions hold true, which to be fair is somewhat unlikely, but it's our best guess, then you would end up with a return of 21% annually over the course of the next 5 years. And this is actually what my Excel calculations also show as the expected internal rate of return. Now, just to add a little nuance here, Wix has actually been diluting its shareholders quite significantly over the past few years. So they have increased the number of shares outstanding each year. And what this means is that free cash flow per share actually grew at a slower rate than total free cash flow. And you can probably expect Wix to continue diluting shareholders a little more in the future. So you might actually want to subtract a certain percentage, so your expected annual dilution, from your return estimates. Okay, if you've enjoyed today's video, here's actually another video that I'm sure you are going to love, because in it I walk you through the basics of another valuation method, the discounted cash flow method. So as I said, that's how Warren Buffett values businesses. So please do not ignore it if you want to progress as an investor. And in this video right here, I actually apply the theory of that DCF model to Facebook's stock.